Want to know the secrets of successful dividend investing? Welcome to a journey into the exciting yet often misunderstood world of dividend investing. It's a strategy that's been around for ages, a tried and true method of generating a steady stream of income from your investments. It's a strategy that has been used by many of the world's most successful investors. And today we're going to pull back the curtain and reveal 5 secrets to successful dividend investing. We'll explore how reinvesting dividends can supercharge your portfolio, why a high dividend yield isn't always better, the role of diversification in a dividend-focused portfolio, why patience isn't just a virtue but a necessity, and why regular monitoring and adjusting of your investments are key. So, are you intrigued yet? Ready to delve into the world of dividends? Let's get started. The first secret to successful dividend investing is the power of reinvesting dividends. Now, what does this mean exactly? Think of dividends as the fruits of your investments. Rather than consuming these fruits immediately, you can plant them back into the ground. This, in essence, is dividend reinvestment. The benefits are twofold. Firstly, it increases the number of shares you hold. More shares mean more dividends, which in turn can be reinvested. Secondly, it leads to compounding returns. The dividends you reinvest earn dividends of their own, leading to exponential growth over time. It's a snowball effect where the more you roll, the bigger it gets. This strategy may seem simple, but its impact can be profound. Imagine a snowball rolling down a hill, gaining momentum and size with every turn. That's your investment growing exponentially with the power of reinvesting dividends. So remember, reinvesting dividends is much like planting a seed that can grow into a massive tree. The second secret might surprise you. A high dividend yield isn't always better. Yes, you heard it right. While it's tempting to be drawn to stocks with high dividend yields, it's not always the smartest move. This common misconception can lead you down a risky path. Why, you ask? Well, a high yield could be a red flag. It might signal that the company is in trouble. You see, when a company's stock price falls, its dividend yield rises. And if the company is struggling, that stock price might not bounce back. So instead of focusing solely on the yield, it's crucial to examine the company's fundamentals. Look at their earnings, their debt, their overall financial health. Remember, a solid company with a lower yield can often be a safer, more profitable investment in the long run. So don't be fooled by a high yield. It's the company behind the yield that truly matters. The third secret to successful dividend investing is diversification. Picture a juggler skillfully keeping multiple balls in the air. That's you as an investor managing a diverse portfolio. Diversification essentially means spreading your investments across various sectors, industries, and even geographical locations. Why, you ask? Well, it's simple. By doing so, you're not putting all your eggs in one basket, thus reducing the risk. In the context of dividend investing, imagine owning shares from a single sector that suddenly faces a downturn. If all your dividends are coming from this one sector, you're in for a tough time. But if you have a diversified portfolio, the blow is softened. The losses from one sector can potentially be offset by the gains in another. Moreover, diversification can lead to an increase in potential returns. Different sectors thrive at different times, so a well-diversified portfolio can take advantage of these fluctuations. Diversification is your safety net in the investing world. Don't overlook its importance. The fourth secret to successful dividend investing is patience. You see, in the world of investing, patience is more than a virtue. It's a necessity. Dividend investing is not a get-rich-quick scheme, nor is it a short-term play. It's a long-term strategy that requires time, dedication, and yes, patience. Imagine planting a seed. You don't expect to see a fully grown tree the next day, do you? Similarly, your investments need time to grow, to weather the storms, and to bear fruit. It's not about jumping from one hot stock to the next. It's about steady, consistent growth over time. Significant returns from dividend investing don't happen overnight. It takes time for your investments to compound and for those dividends to start making a noticeable impact on your portfolio. It's a slow and steady race, but remember, as the old saying goes, slow and steady wins the race. Patience is not just a virtue, it's a key ingredient in successful dividend investing. The fifth and final secret to successful dividend investing is regular monitoring and adjusting. Now, you might think once you have selected your stocks, you can just sit back and watch the dividends roll in, right? Well, not quite. The stock market is a living, breathing entity. It changes, it evolves, and so too should your portfolio. You see, market conditions can shift rapidly, and the performance of companies can fluctuate. A corporation that was once a top performer may hit a rough patch, causing the dividends you receive to dwindle. That's why it's crucial to keep a close eye on your investments. Regularly reviewing your portfolio allows you to make necessary adjustments, ensuring your investments continue to work efficiently for you. This might mean selling stocks that are underperforming or buying more shares in a company that's doing exceptionally well. Remember, successful investing isn't a set it and forget it game. Regular monitoring and adjusting can keep your portfolio thriving.